I'm Charlotte McLeod with investingnews.com, and here today with me is Eric Nuttall, partner and senior portfolio manager at 9 Point Partners. Thank you so much for being here. Great to have you.
You bet. Good to be with you.
Really good to be catching up with you. I was checking, and our last conversation was all the way back in November, so definitely a lot has changed. One of the sentiments that you left us with at that time was that oil market sentiment was awful, but the fundamentals were not. So curious to just to begin, get your thoughts on if that statement still holds true for you.
Yeah, I'm going to be at the risk of sounding repetitive. Things have obviously changed a little, but I would say from a sentiment perspective, it remains exceedingly challenged. There's been ongoing narratives we've had to deal with. The biggest one now are very clearly tariffs, and that's front and center. And they do seem to change by the day. Dealing with the insane volatility is just something that investors and especially energy investors have had to try to deal with. So I think currently now that the outlook for demand this year is not as strong as it would have been. Most of the reasons for that come down to the tariffs, the impact that they will likely have to the global economy, certain economies such as the United States, China. I don't know if anybody can assess what the reality is going to be at this moment, given just how fluid and dynamic it is. A ratio I kind of keep in my mind is for every 0.1% slowdown in GDP, growth translates into about 100,000 barrels per day hit to global demand growth this year. So we've seen a lot of agencies cut their demand forecast to roughly 7 to 800,000 barrels per day, give or take. So that's down roughly 500,000. From a supply perspective, I'm sure we'll get into under the plus category, we've seen a significant slowdown in US shale. Shale grew last year in 2024 by the slowest pace since its inception. And for a few different reasons, we think we'll actually have declines this year. But then at the same time, you have OPEC or OPEC plus members of a voluntary deal uh, accelerating the return of those curtailed volumes. So it's a bit of a wash. We're starting with fairly low global oil inventories, demand a little weaker than thought, shale not growing as much, OPEC adding more barrels. So we do think we're in an environment now for the next 9 months, year, maybe a bit longer, where we need to balance the market by absorbing OPEC barrels by curtailing non-OPEC supply growth. And we already saw that happening. It's just perhaps it has to happen a little bit more. So that comes down to a price, which $60 feels like the price level to balance the market. So that would be dialed down probably about $10 from what we were thinking the last time we chatted.
Okay, I think that gives us a nice overview, a good place to start here. And definitely we want to dig into many of the points that you touched on. So I think starting with supply, if we could take a closer look at supply. When we spoke last time, one of the concepts that you highlighted was the twilight of US shale. And recently you posted another video on that topic, looking at some comments from Diamondback Energy. So wondering if we can begin there, look at those comments and why they stood out to you and were important.
Yeah, they were important because they affirmed our view, which we've been speaking about for probably 9 months to a year, and that was we were already forecasting like a meaningful slowdown in the rate of growth from shale, and it's unbelievably important because we're not for the rise. Non-OPEC production would have already been in decline. So we've been watching this, and it's kind of like the tip of the spear to establish, okay, when that is the precursor to the next mega bull market in oil. And so I mentioned earlier, like we already saw that slowdown to 2024, slowest pace since its inception, excluding COVID. And so when we looked at the spending plans of companies that are now under major change due to the volatility in the oil price, when we've talked about how we thought shale companies are running out of tier one, very good quality inventory, they're going to have to drill tier two, tier three, the wells aren't as productive, they're gassier, et cetera. In this earnings season, to have a company like Diamondback, which we regard not just as the best shale company in the Permian, but probably in the world, for them to come out and reaffirm all of our views, talking about how scarce inventory is of quality, how efficiency gains can no longer make up for, geology, i.e. wells getting worse, that they need an oil price of 65 to 70 roughly, and a better macro outlook for them to start growing again. And so when you think about if that's a company of that quality that's starting to dial back spending that will have an impact on production, then think about the tier two or tier three companies that have been really the marginal guys adding barrels. And so the twilight of shale, whether we plateau whether it's a plateau, whether it's a decline, is really price dependent. The storyline is we've lost the meaningful marginal source of supply. We're now reliant on OPEC, and we're reliant on other countries with long lead projects to satisfy. We think will continue for years to come.
Okay, good overview of that as well. And of course, that's really in contrast to that drill baby drill
Mm.
rhetoric that we had during the Trump campaign. And
Oh, it's
again,
brutal.
yeah, go ahead.
I just drill baby drill's driven me just absolutely nuts. Like it's just crazy because you hear of the politicians and Chris, right, the energy sector and Donald Trump of course coming out with it. And then you hear that and you're like, okay, we're going to grow production by 3 million barrels per day. And then you talk to the companies like, what are these people talking about? Like they're driving the oil price down, not up. The Dallas Fed survey shows that we need $64, $65 oil for these companies to have any semblance of economic returns. But magically, they're going to, self-willingly put themselves into bankruptcy by growing oil production down to $50 oil. Just it's so nonsensical, but it's so damaging to sentiment because you'd hear generals, fund managers go on CNBC and they'd be asked, well, yeah, what do you think about energy stocks? Like, wow, drill, baby, drill. We think supply, the market's going to be oversupply. The oil price is going to fall to $40. It's like it made no sense. So to your point, the contrast between what the companies are saying and then what I'm going to suggest perhaps a less informed president or even energy secretary now are saying, the contrast between those two are quite laughable.
Yeah, yeah. And you did tell us the last time we talked, this is ridiculous. So yeah, of course, nothing has really changed there. Curious to hear a little bit more about Chris Wright. We talked about him last time as the pick from Trump.
Yeah.
Any thoughts on his what he's done so far?
I think it's a lesson that when people go from private life to public life, and you have a president as strong willed and strong personality, I think perhaps you have to fall in line and say things that you may not fully believe in. Because you look at what the Department of Energy is putting out. They even put out a meme over the weekend with, when oil was falling, it was like drill, baby, drill. And it's just like, it's a little, I'm not going to say disappointing, but the belief then was we would have a really, really well-informed guy who knows the business going in. And yet when they make public commentary about how the sector can thrive at $50 oil, and that was walked back a little, but still it's not quite the catalyst that it may have been for US energy stocks anyways.
Yeah, yeah, I can definitely see what you mean there. And so we've had this transition of power in the US and of course also in Canada. So of course want to talk about Mark Carney as Canadian Prime Minister right now as well. So I wonder for you, I know that wasn't the verdict that you were hoping for in the Canadian election. Is this going to be a Justin Trudeau 2.0 situation or
Yeah.
do you see changes?
Yeah, life is filled with disappointments at times. You just have to move on. What is said in the campaign trail versus what turns out to be a reality are two, I think, very different things. And so I just don't think we have enough information to make an informed view as of today. Later this week, there will be the release of Carney's cabinet. And so it's up to him to decide, is the next four going to be a repeat of the past 10? If they put in, Stephen Guilbeault as the environment minister, Jonathan Wilkinson as the natural resource minister, who famously last year said that he thought that the demand for oil was going to be peaking last year globally, and that natural gas demand globally was going to peak by 2030, where more informed people think we've got decades and decades of demand growth. So if those people are in place, to me, that symbolizes a continuation of the past 10. And the past 10 years really have been an era of suppressing our natural resources, our energy sector, putting through legislations like C-69, which makes building a pipeline or mega project absolutely impossible, anti-greenwashing and an emissions cap, a production cap, a bank tanker ban. The list goes on and on and on and on. And so we will see. I'm not watching necessarily words, thankfully, because you could read a book. I've got it around here somewhere written 4 years ago by Carney called Values, where they talk about the necessity to strand assets and keep hydrocarbons in the ground to meet climate goals, and how he, was really speaking well, highly of Greta Thunberg. So I am hoping actions differ from words of the past several months and past several years.
It's a tricky time to be talking because so much is uncertain right now. So we'll wait and see. I was going to ask you what you made of his Canada as an energy superpower comments, but maybe it's
Yeah.
a little too early on that too.
Well, you can't be a superpower, but if you retain legislation which prevents you from building a pipeline. So unless the government is going to build another pipeline, which it actually I could envision, I could see him using that as a carrot to get the industry to move ahead on pathways without incremental investment from the Alberta government. I just that's going to be a tough sell, but I just with existing legislation, you cannot be an energy superpower if we do not expand our ability to export. And we cannot expand our ability to export under existing legislation. That's been made extremely clear by the companies responsible for building out the infrastructure, like the pipeline companies. They're not going to take on the risk. There's so many vagaries and having to do a gender-based analysis on a pipeline, which to this day nobody really even understands what that is. And the PTSD from prior processes is still very, very fresh. So we have to, again, to your point, the next couple of weeks, I think, are going to be extremely telling. And again, if this is a continuation of the past 10, our view is we're bullish on oil, very bullish over the medium and long term, especially. Natural gas, we're very bullish with. So for Canadian companies, if we cannot increase production because we don't have pipelines to move it through, or even gas for that matter, what it means is companies will benefit from the high commodity prices. They won't have the means to invest. So therefore, free cash flow will be higher, and therefore the share buybacks will be more meaningful. So we think actually under a Carney government, our guess, if it's not as supportive as they could be as whom we were hoping to be in the seat, it just means more share buybacks for Canadian oil companies.
Okay, I think that's an interesting summation of what we have going on there. And so, of course, I like to focus on what's happening in North America because that's where we are, but we should take a look at what's happening with OPEC as well. So we had the latest meeting and we learned that they will be boosting output more than expected in June. So I'm wondering if I could get your takeaways from that meeting and what we should expect perhaps moving forward.
Yeah, I was in Riyadh earlier this year before the first acceleration. So that the members of this voluntary deal for two meetings in a row now has said, okay, we're going to accelerate the return. We're going to triple what we had scheduled. And when I was in country, then that was not the consensus, and it was widely believed that they would actually keep deferring. So I think there's a few reasons for that. It's not for the reasons which I think many believe. There's some grand deal struck between, Saudi Arabia and the Trump administration, and there's some defense deal or nuclear deal or whatnot. Again, this week, Trump is in the Middle East and he's in Riyadh, I think, as of now anyway. So we shall see. But we think the real reason is Saudi very clearly saw of a voluntary deal. They were the only country really that were adhering to it. And so a deal is a deal only until, everybody falls in line and actually honors their word, which Saudi Arabia was doing. Others were not. And so Kazakhstan especially was the problem child. And so we think this was a bit of a spanking to try to get them in line in terms of compliance. We have yet to see that. We've seen statements made by their energy minister and walked back and other statements. And so what we follow is the data. And as of this morning, we can see no signs of improvement from compliance from Kazakhstan. Over the weekend, there were reports from Iraq, which is another chronic cheater, that they would be adhering and they actually met their target. But until Kazakhstan falls in line, I have a difficult time seeing Saudi Arabia wanting to continue to carry the burden because the cheating is so obvious and it demeans the value of OPEC's communication and the value of future deals, if future deals or arrangements need to be necessary. So until compliance, like I check it almost every day, until we see compliance from Kazakhstan, I guess I'm thinking the game plan is for them to continue the acceleration. And what was going to be an 18-month process is a 6-month or 9-month process, whatever it's going to be. And therefore, the oil price will have to fall low enough to kill US shale growth and other shorter cycle non-OPEC supply. And that's roughly $60.
Okay, so this is a punitive measure for those other countries involved there. Okay.
Yeah.
So I think we should you talked about demand at the beginning of the conversation, just giving an overview there. I wanted to get a little bit deeper into what's happening because we've got a lot of concerns, not just in the US, but globally as well, about a recession or even possibly something worse. And of course, that would weigh on demand. We've got the tariff uncertainty that we've touched on here and there. So when it comes to demand, is there anything we can really know for certain at this point?
It underlines a theme that we've touched on a few times, like uncertainty, volatility. And that's creating opportunity in the energy stocks. But for oil, and it's the reason why we've increased our weighting towards natural gas pretty meaningfully. There is just too much uncertainty to have super high conviction right now in terms of demand. Like supply, we feel pretty good about. We've just had $1.8 billion of CapEx cuts announced in the last week and a half from companies. We can triangulate our views with comments from public companies and try to figure out, okay, shale, what's it going to be doing? Um, OPEC, we can guess. We have some semblance of an idea, but demand's the biggest unknown. And so until the market can have conviction that inventories are not going to balloon and that the price is going to crash to like everybody competes with themselves to see who can be the most bearish. So, the most bearish guy now is calling for 40. Well, he's just pulling numbers out of the air. Like there's no logic to that. Why not 50? Why not 53? Like our view is it's the oil price to kill shale. That's 50 to 60. Really, it's 60. 50 would be a really like sharp economic slowdown. We don't see that being necessary. So it's tough to have conviction in the oil thesis today until we have some clarity in terms of what's Trump's ultimate plan on the tariffs. What is the baseline? Is it if it's a 10% baseline on everybody, fine. We can deal with it, evaluate it, measure it, and then move on. If it's something else and it seems to change week to week, day by day, hour by hour, depending on who's on CNBC or doing an interview. So it's that maybe we'll pivot towards natural gas later on, but it's a thesis that we can have a lot more conviction in. We don't have to be worried about a global recession, a US recession, you know, peak demand, OPEC policy, what's Trump going to say today on Twitter? Like it's why we think natural gas stocks are going to outperform over the short term, at least, relative to their oil peers.
Okay, and I think you hit on a point. It is so difficult right now to move on from anything when it's happening as we speak, and it keeps happening. So, anything further you can share on the portfolio breakdown right now? So, a little bit away from oil toward natural gas.
Yeah.
Anything else you can say?
Yeah, so that's the biggest one. We've got a little bit of cash, nothing crazy. Energy funds in North America have been in redemption mode for well over a year, so that's nothing new, expressive of challenge sentiment. So now we'd have the highest natural gas weight I think that we've ever had of our equity exposure. It's probably about 70% with 30% in oil. Service stocks are just uninvestable right now, given we're at the beginnings of CapEx cuts, and you could argue that they're inexpensive, they're cheap. I struggle to see how they're going to perform other than on days, like today when we're recording this, where names are jumping on headlines. But so we think natural gas, we're increasingly believing in a $5 price versus four or less for 2026. When we look at drivers of demand, it's all about LNG. The United States is exporting 16 BCF a day now. It's unbelievable. That's growing to 26 to 28-ish by the end of the decade. Canada, we're going to have our first export next month or the month thereafter, June, July timeframe, which is wildly bullish for Canada to decrease the discount that we sell our gas for. So even if we're a little high, like $4 to $5 gas with what will likely be a $1.10 discount for Canadian gas in USD relative to that, the free cash flow yields of these companies screen exceptionally well. Like we can buy companies at 15 to 23, 24% free cash flow yields at $4 to $5. We don't have to figure out what Trump's thinking or figure out what demand's going to be doing or figure out, what's OPEC thinking, all of those different things. It's all about assuming normal weather, that it's the build out of LNG, AI data centers. Sure, it's there as well, but it's really the build out of LNG. So we can just have a much higher conviction in the demand thesis. Supply, when we talk to companies, we do think $5 is closer to the marginal cost than four. When you think about where the necessary gas is going to come from, mainly the Haynesville, privates, publics. So we feel fairly good about a 4 to 5, so long as we don't get skewered by Mother Nature this summertime. But it feels like a much higher conviction call.
Yeah, honestly, it sounds a little bit simpler than the oil story there. And one more point on the portfolio. You had mentioned last time we talked being a little bit more diversified because the energy mix was diversifying. And I believe you spoke about a coal company. Are you doing anything else outside of oil and natural gas?
We continue to look for opportunities. The coal names have just been destroyed. So we were able to move on and minimize the loss. And it was one name and it was fairly small. Like we were early doing the work. We do think the demand for all things energy is going to expand, including alternatives. but really we see the mega growth in natural gas. Gas has gone from a bridge fuel to the fuel. Oil demand we think will continue to grow, but maybe a little less than historical levels. Maybe a new run rate is 800,000 to a million, not the 1.2 to 1.4 million. Time will tell. We've looked at uranium. I continue to think that every environmental zealot should be the biggest champion of uranium energy. It's truly the only form of clean energy in the world. But the build-out cycle is measured in decades. I'm not hugely fond of the mining model. And so when I can go out and buy names in oil, natural gas, trading at what we think are anywhere from 10 to, I'm going to say 18% free cash flow yields. Well, free cash flow doesn't really exist in the uranium stocks. And if they do, like you're talking about like a 4% free cash flow yield, that doesn't excite me. So there are merits to being diversified. There are merits to triangulating and focusing your energies on names that you really think can outperform, where you can buy into companies with decades worth of inventory, 40, 50, 60, 70 years, where the balance sheets are exceptionally strong. In many cases, they have no debt. They have cash on the balance sheet. They're not growing. If they are, it's like modest, couple percent, and they're returning all that free cash flow back to shareholders. And then it's just a function of the oil price. So it's 60, maybe they can only buy back, 68% of their stock over the next year. And it's 70, and I think we're going to be at triple digits in the next couple of years. You're looking at meaningfully higher free cash flow yields than that. So it's difficult for a coal or uranium service stock, certainly not alternative energy, to compete with what we're finding in natural gas and still oil.
I think that's fair enough. Although if you ever get excited about uranium, please let me know, because that is a favorite for our audience for
I
sure.
bet.
Okay, well, we've gone over quite a bit today. I will let you go unless you had any final thoughts you want to share about oil, natural gas, the energy sector overall.
I would just say we remain bullish on the medium and long-term outlook for oil very much. There's just some short-term demand uncertainties that we have to get through. The market just has to do what it's going to do to rebalance things if demand does slow down to the degree that some are expecting. And if OPEC continues to add more barrels from their voluntary deal at an accelerated pace. But ultimately, we see scarcity in the oil market at a time when demand will continue to grow very, very, we think for many, many years to come. And so it comes down to in the interim, then where can you find the best opportunities? And it comes down to natural gas. And as you said, the thesis is just so much simpler. And you get no pushback, right? It just comes down to, I can't tell you what the summer weather is going to be. So the build out of LNG is starting to nullify the necessity of Mother Nature cooperating. But we can look at supply costs, and then we can look at, structural demand from LNG, that it's all FID, they're in progress, et cetera. Very little risk to that build out. And then we can look at marginal cost, and then we can figure out, okay, what's the free cash flow yield, and share buybacks remain in place for these companies that have the same theme, decades worth of stay flat inventory, modest growth, meaningful share buybacks over time. So, I would caution energy investors, don't be too bullish, don't be too bearish, especially on the bearish side, because we live in a world where things can change with a single tweet, a single announcement. And so you don't want to buy into the negativity that we've been dealing with for what feels like an eternity now. We remain bullish on the outlook for energy stocks over the short, medium, and long term.
Okay, well, really great takeaways as usual. Thank you so much for coming on to go over all these topics.
My pleasure.
Of course, and once again, I'm Charlotte McLeod with investingnews.com, and this is Eric Nuttall with 9 Point Partners.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.